Good morning. Welcome back to the Retirement Report. I'm Hank Parrot, your host. All right, we were talking about these the three different types of income. I'll come back to that. But first, I just want to offer up to you, if you'd like some help, maybe a personalized plan for your own planning, all right, a comprehensive financial plan that deals with these topics. It deals with how to minimize taxes, how to develop a tax-efficient retirement plan. If you'd like some help with that, just call my office. The number is 615-376-5325. We're going to look at what you have for income, expenses, assets, liabilities. We're going to factor in for inflation, for taxes, rates of return on your money, and we're going to project ahead for you, be able to show you your financial future based on the things you're doing today, and then share with you strategies I've developed over the years to help you improve that picture, help you reduce taxes, help you improve returns, help you get the income that you need to make sure you're able to attain and maintain your standard living quality of life no matter how long you live, never have to worry about running out of money. In fact, let me, if we would, I get the camera here for a minute. When you call in, we're going to give, I'm going to send you out a special packet. There we go. So we've got a financial lifestyle fact finder and our financial lifestyle expense report. These will help you in gathering up the information we're going to need to do that kind of planning and that kind of retirement capital analysis report that we do. We can look at investments. We can look at if you've got annuities, right, and you're not sure about them, we can help you with that as well. A better understanding of the annuities you have, depending on how long you've had them, how best to get the most advantage from the ones that you have, and maybe even show you some things that can work for you, where you might even, if you've had an annuity, for instance, for 10 or more years, it's very likely there's been a lot of improvements, a lot of better products come along, and there might be something that would do better for you than the older ones. Any of that we can help you with, all you need to do again is call the office, 615-376-5325. When you call in, we'll get your information. We'll send you out a checklist of the product I just shown you, of things to bring to your appointment with me. And when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. Okay. One of the things, I'm going to go back into this with taxable. We were talking about 3 categories of income in retirement. One of them being taxable income, the other tax-deferred income, and of course tax-free income. One of the keys to that is understanding we'd like ideally to have some money in each of these. So let's see. On the headline it says to have retirement income in all 3 categories of the plan, right? The reason is no one can predict the future, all right? What we're looking at there basically is that there may be changes in the economy. We've seen that, right? Or like a recession or inflation. There may be a drop in the stock market. We've certainly seen that as well this year, which could affect the value of your investments. And there may be changes to tax laws, and we know that's coming up. So we have to be planning for all these, and the more diverse your income sources are, the easier it is to adapt to that in different conditions. So these factors could affect different categories in different ways. So again, it's wise to have money in all 3 categories if you can. So we want some taxable money that's just maybe in the bank or in a brokerage account. Tax deferred, we want here, maybe if you're fortunate enough to have pension, but for most, you're definitely going to have some money in a retirement account. For many of us right now, the retirement account is our biggest asset. So when we're looking at 401k, 403b, 457, SEP IRAs, traditional IRAs, again, certain annuities, all of these tax-deferred accounts that we're going to be pulling from in retirement, the more of these 3, and tax-free, of course, as we were talking about with Roth 401k, Roth 457, Roth IRAs, life insurance cash values, certain municipal bonds, mainly for higher income again. Munis can be tricky. We think if you're in the lower brackets, you're going to probably do better with a corporate type bond than a muni bond. But again, that's going to be individual. I'm just letting you know, if you're in lower brackets, those munis typically pay lower interest because of that's tax-free than what what a better, say a comparable corporate bond might pay. Non-taxable part of your Social Security benefit. So here again, ideally you want some in each one. That's going to help us with the planning, and we're going to give you an example of that. Okay, so take a look at this next slide, diverse retirement income sources, how they can help you pay less tax. So here, in the example, again, this program was developed by Nationwide Retirement Institute. And so in their example, imagining two couples decide to take their grandkids to the Grand Canyon. For each couple, the trip would cost $10,000. But before they go, both couples need to pay contractors for home renovations. And to cover this one-time expense, each couple needs another $10,000. So each couple basically needs $20,000 on top of their usual retirement income. So let's assume each couple normally draws $100,000 of retirement income per year, so they need $120,000 in all. Okay? Now, let's look at the two options then available. Each approached it differently. Couple one, right, decides to take the extra $20,000 out of the same account as the $100,000 for their retirement income. So that is their tax-deferred 401k plan. That means the entire $120,000 is going to be taxed. Couple two on the other, so their total tax is going to be $11,300. Couple two on the other hand has some account diversity, including a savings account and a Roth IRA. So they take $10,000 tax-free from the Roth, and they withdraw $10,000 tax-free from the savings for the renovations. So that means they only withdraw the usual $100,000 for their tax-deferred income. Look at their taxes, $8,140. They basically save $3,200 approximately in tax by having the diversity, the diverse retirement income sources to draw from, savings sources, if you will, compared to the first couple. And this is where you can really help yourself if you're putting, not everything just goes into a 401k, and there's some guidelines that we use. For instance, if you're in a 22% bracket or higher, yes, you're probably wanting to fully fund your 401k as much as you can to reduce your taxes. However, if you're only in a 12% bracket, and when you retire, you're not going to go into a higher bracket, but you're going to stay in that lower bracket. Well, why save 12%? In fact, I was talking to a couple here this past week. They were in a 12% bracket now, but when they retired, because of their RMDs and other things that other income sources they were going to have, they were going to be in a 22% bracket. So basically imagine, right, you'd be saving 12% now and turning around and paying 22% when you start taking the money out. Doesn't make any sense. You're better off to take that money and instead just put it in a savings or a brokerage type of account where you don't need to save the 12%. Just put the money in there. Or if you're going to do anything, put it, and you want to, first fully fund a Roth, whether it's a Roth IRA or if you have availability to a Roth 401k, then do that. Put the money into a tax-free account. You're not going to get the deduction, but again, why worry about saving just 12% on my taxes, on that amount for taxes, when I'm going to pay even more when I take it out? Better to put it into either a Roth, where when I take it out it's tax-free, or into a brokerage account if I've already maxed my Roth out. So all of this, there's a whole strategy that goes into, or a number of strategies actually, that go into how to reduce your income in retirement. And having diverse accounts, having some in taxable, some in tax deferred, and some in tax free, is going to allow you many times to stay in a lower tax bracket. Many people live in retirement on Social Security benefits plus maybe a pension or retirement accounts, of course, like we were talking about with 401ks and the like, or any savings in the designated Roth accounts in a plan. If these are your only income sources, you may not have a lot of flexibilities. They may end up getting you taxed at the higher tax rates that we were talking about earlier. So one of the things that we want to go into with you, we can go ahead and get rid of the slides in. the whole point of all of this, and we got through it, so this is good, but if you want some more help, if you'd like a personalized plan, if you'd like to see how these tax rules can be used for you, right, to your advantage, to understand those tax rules, understand how to work the system so that you minimize your taxes. Again, we don't want you paying more in tax than you're legally required to pay. It's amazing how many people do simply because they don't know the rules. Well, now you've got a good head start on understanding those rules. And again, if you need some additional help with that, just call my office at 615-376-5325, and we're happy to help you with a comprehensive plan, or maybe just answer some questions that help you get on the right path there to minimize taxes on your retirement. I hope this has been helpful for you this week, and that you'll join me here each and every week on the Retirement Report.